Thank you very much for having me. Look, I think the markets are driven by two factors at the moment, higher interest rates and higher inflation, and that is going to be continuing for the rest of the year and even going to 2023. What we do and how we protect our clients' money in this bear market, if you believe in that analogy, is really you need to be invested in short duration equity incomes, in the sense that short duration protects you from that higher interest rate environment, and equity income, of course, is a protection and a hedge against inflationary environments.
What about the underlying assets, though? I mean, a solid old week for the bond market, with the 10-year dropping to, 2.89 as of the close on Friday as well. We're not going to get much bond trading out of the US today. But in terms of, I hear what you're saying about income. I hear what you're saying about short-term management of your portfolios. But the problem is, if the underlying product is going down because of those dual risks you mentioned, recession risk and higher inflation, yes, you'll get the income, but your underlying asset will be declining.
Look, I think for just looking at the long-term yields, we still think that they have room to move higher. So around 20, 30 basis points move higher in the long-term yields until we see a major stabilization in inflation and inflation expectations. And in this environment, I still do believe that value titled high dividend yield, minimum volatility is going to perform. Of course, to your point, I think the market is pretty indiscriminate in punishing even those high quality companies. And for that, I would say to investors, be a little bit patient, stay with your conviction, long-term conviction. Trades are, at this moment very messy because they are, the technical indicators are very weak. Wait a little bit and then again go further into those aspects of the markets that is going to come back once that bear market environment is over.
Lale, can I ask you about market pricing then? Because we have sold off very aggressively. There's some valuation fears, down 20% on the market. But the point has been made, we've sold off for not the right reason in some ways. We haven't sold off because of a recession necessarily. And if that market pricing is not reflected in the sense that the market has sold off because of a recession, doesn't mean that there's more selling potentially to come. Or do you think we're in the range where we've sold off 20%, average recession sell off about 26% anyway? Are we in the range anyway where we don't need to worry about further downside for markets?
Look, I think the bear market is going to stay here for a little longer. We had the shortest bear market. People compare it to the COVID bear market, but it took 23 days to go down and 103 days to recover. And of course, that was the shortest one that we've seen in history. I think for the multiples, but if you look at the multiples, the compression that we have seen so far is really coming from the numerator side, where we haven't really seen anything on the earnings side, which, as those recessionary risks are going to be priced in, the analyst estimates are really going to come down in the next 12 to 18 months. And that's why I'm saying that stay here for a little longer until we see a major uptick in an indication that a soft landing may be possible. So.
Can I also ask you about margins? I want to pick up where I left off on Friday. We were talking about whether we now start to see some of the pain taken on by companies instead of customers, that those margins had to start being reduced at some point as companies just can't simply keep on passing on increase after increase along the chain. Where do you think we're at when it comes to margin pressure?
I think this year and even the first half of next year is going to be really about those companies that can really pass those higher input cost prices to their consumer. And for that, I'm looking at places such as energy, materials, to some extent, healthcare as well, where healthcare especially is a place where those margin pressures are felt the least. And therefore, it is one of our favorite places to put money into.